Hey everyone, topic number 3 with Mr. Greg Dickerson, expert of the week. Monday kickoff is where's the boogeyman? What is out there that we need to be watching for that nobody is thinking about? I know where I'm thinking, but let's see what Greg's thinking. How you doing, man?
Good, Michael. How are you today?
I'm doing well. So what are you looking at given your experience, you're doing deals that maybe the average Joe investor, new investor isn't thinking about? Is there something that you're looking at that you don't think others are looking at?
Well, it's not that I don't think others are looking at it. I just think that I've got a very different perspective than a lot of people. Number one, I'm a developer. Okay. So a developer by trade has a very different outlook on things when it comes to risk,
Mm,
calculating risk, accurately estimating risk, understanding risk, and everything that can potentially go wrong in a deal, project, economy, whatever.
okay.
So I've got a very different outlook. So a developer, I'm looking at it from an investor standpoint, long term, short term, risk profile. So what I think the assumption is now is interest rates are going to stay low forever, that funding is going to be freely available like it is, and that values are going to continue to go up exponentially and never come down. So what I see an environment very similar in terms of the positivity and the speculative um, aspects of assets like we did in 2008 and 9. So I see
Wow.
a very dangerous environment and mindset of values only go up, interest rates aren't going to change, and short-term interest rate, interest only, those types of things on loans deals, whether it's companies or it's real estate. So I think that's a very dangerous mindset to have versus my outlook, not only what can go wrong, what is going to go wrong, how am I wrong, and what am I missing? That's how I approach every single
Interesting.
decision that I make, whether it's a business, whether it's a real estate deal, whether it's an investment, doesn't matter what it is.
Yeah, I love how you broke that down. I'm gonna have to watch that again. When I look at my little, single family home market, the thing that I am looking at as the boogeyman is I think the Fed is wrong, right? The Fed has come out and maybe they knew they were wrong and they just wanted to smooth the environment. But this whole we're not going to raise rates for 3 or 4 years. Um, I believe that's going to be proven wrong pretty spectacularly. I think there's a pretty good chance that 2021 is a good, if not great year for the US economy. So we are going to be talking about Fed funds rates raising probably early 2022, which is, by all count 2 or 3 years earlier than they've been talking. And the other thing, just to piggyback on what you're talking about, is I'm starting to see the same. I'm trying to see the early signs of a bubble brewing in one part of single family. Let me explain. FHA, the first time home buyer, is so dominant today that that balloon seems to be growing really, really fast. Not quite the same in, above FHA limits, right? Because they have loan limits, right? So we are seeing appreciation in jumbos and things, but it's remarkably different. So I am seeing the early signs of a bubble forming in what I guess I'll call affordable single family homes.
Mm-hmm.
Not quite as crazy as '08 yet, at least in my market, but the trend is alarming given my past experience. So those are my two things I'm looking at as potential surprises and will cause me to adjust my market because again, I see them and they're out several quarters, but that's a boogeyman that I don't think anybody's talking about.
So you got a couple of different things there. So from a Fed standpoint and interest rate policy, so again, the assumption that rates can't go up, and they really kind of can't. So the Fed has tried to raise rates in the past, and Fed rates are very different than mortgage rates. Okay, so they've tried to raise rates, and every time they do, they get slapped down by Wall Street, and they get slapped down by people looking to purchase our debt. Okay, and in order for the Fed to be able to issue debt and continue to fund, interest rates have to be low
Mhm.
so that there can be somewhat of a spread. Now, here's the real question. Here's the real issue. If you're looking for a boogeyman, is what happens when the rest of the world wakes up and says, "Wait a minute, if we stop buying U.S. Treasuries until rates are pushed up for
Mm,
our yield, okay, then what happens, right?" So these, like China's already backed off a little bit and sold some of our treasuries. And again, it's a guaranteed thing because we can print as much money as we want to pay that interest payment. So if I have a printing machine of legal currency and I say, Michael, lend me $1 million, because I can keep printing that payment back to you, and I can print your principal back at any point in time, and it's still kind of work the same. You're going to take that deal all day long because you're getting that return on that investment. Well, at some point, these sovereign nations and wealth funds start looking at us and looking at our debt and say, wait a minute, I want a little bit more return for that risk, because
Mm,
the United States is in a bubble. Okay, so if I'm going to buy your debt and give you my money, I want to make sure I get a little bit more for it. So they might start demanding a little bit more, which is going to increase the rate at which the treasuries are issued, which
yeah.
increases interest rates. And mortgages, that's what they're based on. Mortgages are based on treasuries.
Hmm.
So the boogeyman is, for what you're talking about, the housing bubble, is foreign nations, sovereign wealth funds, institutional investors, pension funds, life insurance companies that are buying our treasuries, buying our bonds, are going to say, I want more for that risk. They're going to see it as more of a risk asset. That's going to drive rates up, which is going to affect values in housing. So again, the only reason housing values are where they are today is because of interest rates. 2.75. My wife and I were talking about this yesterday. She didn't even realize it. 2.75% interest is about half of where it was, 3 or 4 years ago. Typically, the upper fours is a good rate.
Yeah.
Literally, houses, you can pay twice as much for a house now as you did back, in 4 or 5 years ago, 3 years ago, because interest rates are about half of what they were.
Totally agree.
So it brings that's why the values have gone up, just like automobiles. You pay $75,000 to $100,000 for an average pickup truck or an SUV now, because you can finance them for 6 or 7 years. That's the only reason. If our financing was 3 or 4 years, these vehicles would not be selling for as much as they are. Same thing with housing. So you're right. There is a bubble there, but the thing is that people need somewhere to live.
True.
If you've locked in at a low interest rate, the chances of defaulting on that strategically because the value is dropping 2 or 3 or 4 years from now by 20 or 30% are pretty slim,
Yeah.
because you're not going to be able to replace that payment for the amount of house that you have.
Very
you
true.
know so it's going to go the other way, in terms of the cost to own that house. You might be able to get a little bigger house for the money, but the cost of that ownership is going to go up. So likelihood is you're going to stay where you're at. You're going to wait for this rate thing to balance out. But most of the smart money minds out there don't think that interest rates are going to spike exponentially anytime soon, just simply because the Fed can't. If they start raising rates, everything tanks. Stock market, real estate market, everything. So we're kind of stuck in this mode where you really can't raise rates. You got to kind of keep printing money. And as long as we have buyers for that debt, which we will, because a little something's better than a lot of nothing, and they know that we can exponentially continue to print to service that debt, it's kind of what we've been experiencing the last, 10 years, since 2009, 11 years.
Yeah. So again, I think we're gonna find out. I think it's gonna be pretty soon. I think 15, 18 months out. I think we're gonna have. I think what's really the boogeyman that kind of causes rates to rise is inflation. Right? There's been a debate about inflation, deflation. I think as of this morning, I think deflation is off the table. I think, but inflation is still out there. And if the economy picks up, like I think, if the U.S. prints a 3 or 4%, GDP growth in 2021, that's pretty significant.
You can't have real inflation at the consumer level, which is what inflation is,
Mhm.
until everybody has money in their pockets and they're
Yep.
spending it.
Yeah.
All right. That's not happening, and it's not going to happen. And it wasn't happening when the economy was booming. Remember,
Okay.
pre-COVID, we were at the best economy we'd ever had, and we still didn't have inflation.
Okay.
You only had it at the asset level. You
Hmm.
didn't have it at the retail consumer level. Now, people might argue with you on that because, yeah, food's expensive right now, things like that, but it wasn't exponentially expensive where you had serious issues of inflation. It was just kind of relative to where
Okay.
we're at. Incomes haven't gone up,
Yep.
significantly. So you're not seeing bidding wars, for labor. You're not seeing bidding wars, for a lot of different things, and prices exponentially growing. Even in housing, you've got bidding wars, but people put a ceiling on it.
Yeah.
They're not paying whatever. Some properties are still sitting when they're priced inappropriately. So the only way you can get real inflation, because we're a consumer driven economy, is that
Sure.
everybody has to have more money in their pocket.
Hmm.
So not only do you need to get the economy up and running and back open again, you have to replace all that lost liquidity. You got to remember, there's a ton of liquidity that the average American has lost, that
True.
had to close their business, lost their job, or have gone through savings that were affected. Now that's probably 30 to 35% of the population out there. There was still a big group of people that were not affected by any of this,
Hmm.
and aren't going to be affected by any of this, but there's a big chunk of it that was.
Yeah.
The other thing that drives inflation is people being able to borrow money to then spend. Okay, that's what drove inflation pre 2008 9, because anybody could go get a line of credit on anything,
Yeah.
and then they would go out and buy that new car, buy that vacation, just do whatever. All right, you can't do that anymore. Remember, you got to qualify for a loan. You have to have good credit. You got to have reserves. You got to have cash. Savings rates are up. Spending is down.
Yeah.
That has to flip. And the only way that flips is if people get all kinds of money added back to their pocket. That's not going to happen if your taxes go up. It's not going to happen. And taxes have to go up.
Oh
You
yeah,
know,
for sure.
they will. So, there's a lot of things that have to happen in order to create inflation. And that's the big problem the Fed has right now, is they can't create inflation.
Hmm. It's going to be fun,
They
man.
just can't do it.
Yeah, this is going to be fun to watch. Again, today's an interesting day because again, we have a light. We don't know how far it is, but it is a light. I'm thankful for it, right? Science wins. I think hope beats fear again, which, in my experience always does, but there's
Yeah.
not a lot of people preaching fear, 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 depression, 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 depression 2.0. I've never seen it. And now I can firmly say that's off the table. Would you agree?
Yeah, yeah. I mean, the coronavirus is still out there. It's at large. So the double dip recession,
Yeah.
it's a coronavirus recession. It's not a real recession. As soon as we get that fixed, we can turn the light switch on and people can get back to work and stuff can start opening. It's going to take some time to ramp it up and to get it going again. And people have to replace, that lost liquidity and reserves. But yeah, you know, you know, huge issues at mass. You still with me?
Yep.
I had a call
Gotcha.
come in, but I had it blocked.
That's
Um,
okay.
so yeah, I don't see depression. I don't see serious recessionary issues, assuming we can get the coronavirus under control. That's the big caveat.
Sure.
Can we get that under control? But we've been through the worst of it. We've gotten to where we've gotten to. We know how to control it, and we survived at scale, lockdown at scale, and still made it through.
Yeah.
And the government knows what it needs to do to fix that. If that happens again, you got to start writing people checks and replacing that lost liquidity.
Totally agree. Well, this has been a lot of fun today. I appreciate you giving us some time when you're out looking at deals. Thanks, man.
Yeah, man. Good to talk to you.
Thank you.